So with Wall Street facing all of the year-end losses, but particularly what we're hearing from some of these local companies today, what to expect? James Gerrish is joining us now from Shaw Partners. James, welcome. Look, we'll get to City Chic and its profit warning in just a moment, but what I noticed in all of the trading updates coming from these companies is that they are saying the conditions have deteriorated since the AGM in November. And of course, we were calling this AGM sort of a mini reporting season. So this does not bode well for the upcoming February reporting season, does it?
Yeah, good morning to you, Nadine. I think you make a good point there. And I think, but just to put that in context, I think the companies coming out and updating that, they're all the companies that were seeing pretty weak trends into that AGM season. So I think those trends have continued. So you think of Domain has been under pressure. It's trading at 52-week lows. I mean, City Chic is down 90% this year. The business is in a real lot of trouble, and they've simply continued to say that things haven't improved as perhaps they were guiding to at their AGM. So, I think there's a little bit of context around those trends that are playing out insofar as they're companies that have been weak going into this period as well.
Okay, but when it comes to Domain, say in particular, can we immediately expect now to hear similar commentary coming from REA Group?
Well, it's going to be interesting because in tougher. This is going to be a short-term negative for REA. There's no doubt about it because they're talking about volumes being lower. But I think in a tougher environment, you often see the cream rise to the top. So the dominant market player, attract the listing volumes over and above the second tier player. I'm not sure whether that'll play out and what type of volumes that REA is seeing. But Domain's left a lot of work to do in the second half. I mean, to give you some numbers around there, the first half downgrade plus what's left for the second half for them to do. They say, first half EBITDA of 48 million. That was compared to 62 million the market was anticipating. So that's about a 22% downgrade on first half numbers. And if you think about the full year, the market's at 137 million at the EBITDA line for the full year. So that will leave them about 90 million at the EBITDA line to do in the second half, which simply is not going to happen. So some big downgrades expected to come through for Domain, I would imagine, Nadine.
Okay, so watching that, but again, then value comes into the question. If it's trading at 52-week lows, we could be seeing the low watermark, according to it, in terms of performance, and likely, some of the steep falls that we've seen in the housing market have come through already as well. So if you believe in the, overall Aussie housing market, Domain's technical offering, is it looking like good value now?
I'll be just looking at REA coming on stream now, so they're down a bit over 8%, so they're trading at 108 a share. So Domain's down 12.2%. So in my view, I'd probably be looking at the leader in the space. So that's REA. I think you make some valid points around when to buy these cyclical stocks. They've been hit by a pretty significant tsunami against the housing market. What plays out for them in 23 and calendar 23 is going to be dictated by volume. So often you see house prices fall away, which we've seen, but then just dip along the bottom and volumes become an issue. So it depends about volumes as one of the really key drivers of their earnings. So you need to see an uptick in volumes, and for an uptick in volumes you need to see a catalyst on either the upside or downside. So my fear would be that volumes are probably going to stay subdued at the start of 23 calendar year. And then if the RBA guide to interest rate cuts at the back end of the year, that could be the catalyst to then see volumes tick up. So my inclination would be we're close to a bottom, but there's probably no rush to go out there and buy these at the moment.
Okay, 9 coming through, obviously having to account for some of that weakness coming through in Domain. It says that its own cost offsetting program, as well as its share gain, is helping to offset a challenging ad market, a slowdown in the ad market, which we often see in economic periods of weakness with these media companies in particular. So are the glory days over for 9 and say 7 West, at least in the short term, you think?
Yeah, there's some tentative signs that it's starting to bottom out at least. I don't think it's started to improve yet. So in terms of what Domain has come out there and said and the influence on Nine, obviously Nine owns 60% of Domain. Domain accounts for about 14% of Nine's earnings. So it is obviously a negative, but it's not a huge negative, particularly given the offsets that they've come out there and spoke about this morning. So I mean, these guys are deep value. There's no doubt about it. They're down 30-odd% year to date. They're now trading on low single-digit PE. It's if you think that the economy is going to improve at the back end of 23, calendar 23, as the RBA eases rates and there's a few things that you could construct, but you're drawing a pretty long bow there. So right now the market's not sold on the fact that we're going to bounce back in 23. Could be wrong, but right now I think it's they're very cyclical stocks right at the pointy end of economic activity, and we're seeing weakness starting to come through, as you made mention of earlier, Nadine.
Okay, City Chic. I mean, a lot of the same rules apply to it, right? Market darling in the lockdown period. It's had problems with inventories. In its release, again, talking about the AGM and the deterioration, it still says that Cyber Monday, Black Friday, a Christmas trading period will be, instrumental in determining the half, but it's not looking very good. Again, is it a time to start looking at some of these really beaten down retailers, or would you want to see a real turnaround from these companies, particularly when you overlay, the CBA spending data that we got today, which is showing the worm turning. Spending has actually held up relatively strong to now, but we're starting to see it weaken.
Yeah, just on the spending in the top line. So you're right, spending has held up. But if you look at sort of household savings rates, they've also now declined fairly meaningfully and are now back to levels that we were seeing pre-pandemic. So pandemic saw a large increase in savings, put a lot of fuel back into the fire, and now that sort of dissipated a little bit and that tailwind is gone. In terms of City Chic, I mean, a stock that's been completely smashed over the last 12 months. It's down 90% over that period. Today's result, basically they're saying, they were saying that they were going to make a small positive EBITDA contribution in the first half. They're now saying that's going to be a loss. Mm-hmm. So the market was looking for 5 million at the EBITDA line for the half. They're saying that's a loss. The issue there is they've got about 10 million in cash in terms of their last reported number. You made mention of the inventory levels. They had about 200 million in inventory at their AGM. They're now down. They're saying they're going to have about 168 million at the end of the first half of 23. So that is down. But the issue is the revenue is lower, the costs are higher. That's putting a heap of pressure on their margins, and ultimately they're losing money, and they don't have a lot of cash in the bank. So this is a real basket case in my view. Okay. A lot of people will be hurting on this one, no doubt.
Yeah, because it was a favored pick of a lot of small cap investors.
Everyone loved it, Nadine, apparently.
Sure did. Yeah. But what are you saying? Like a retailer coming to market for a cap raise is possible?
Yeah, absolutely. I mean, you keep losing money, and you need to have cash on the balance sheet to do that. You either raise additional debt, or you've got to go out there and raise equity. This is a $140 million market cap, or it was before today's. It's trading down 16% right now. It's at 49 cents. Things tend to spiral in businesses like this, and today's update again. You made mention of being so close to the AGM, and now we've seen a further deterioration in the business, and a 5 million EBITDA contribution turning into a loss. Things are pretty dire there.
One to watch today and beyond. So, James, is there any good news out there? Because I referenced it at the beginning, like Santa's nowhere to be seen for equity investors.
Well, the ASX has done pretty well, I think, in calendar 22. So, the S&P is down 20%, the Nasdaq is down 30%. We're down in price terms of about 4%. We're slightly up if you include dividends. So the composition of our index has been a real benefit to us. The energy sector has done really well, up 40 odd percent. So there's been, the material stocks have done reasonably well. More broadly, utilities have had a good year. So, our market from a relative standpoint has done well. If you're thinking about the short term, the stat I'd leave you with for the short term bulls is that the second half of December, 90% of the time it's up. So, it's a reasonably valid statistic, probably on to do with low volumes and the like. But I just recall there's a lot of concern about the Christmas rally when it doesn't happen in early December, but generally the Christmas rally happens at the back end. So there's still hope yet, Nadine, I'd leave you with.